Hey option traders, for today's trade we're looking at an option strategy known as the short straddle in Boeing stock. This is a great strategy to use if you think a given stock is going to continue to trade sideways for a certain period of time. Looking at Boeing on MarketSmith, you can see clearly on a monthly chart that the stock has been heading lower since early 2019. In the past few weeks, however, shares have bounced off lows and regained support at their 21-day line, similar to the major index's action recently. The stock is by no means set up to make a major run to the upside, although anything is possible. With a composite rating of only 24, Boeing ranks far behind competitors in its industry group like Northrop Grumman and Lockheed Martin, which, when compared by this metric. Also, shares hold an RS rating of only 19, which also pales in comparison to others in the group. For investors who believe the stock will continue sideways from here, you could consider using a short straddle to capture some gains in the stock. So a short straddle consists of one short call and one short put. So remember, with options, there are two types of options, calls and puts. You can either be the buyer or the seller of, just like with the stock. You can either buy long or sell short. For the short straddle, both your short call and short put will have the same underlying stock, the same strike price, and the same expiration date. For example, you'll need to sell one call of XYZ stock with a 100 strike price that expires in June. You then also need to sell one put in XYZ with a 100 strike price that expires in June, and this will create a short straddle. So you will be the seller and receive a premium for the trade that's paid by the buyer. The trade profits if the underlying stock trades in a narrow range between the break-even points of this trade, but the profit potential is limited to the total premium received at the start of the trade. This is the tricky part about this trade because the potential losses could be unlimited if the stock price rises and substantial if the stock price falls. The maximum profit is achieved in the stock if and only if the short straddle is held to expiration and the stock price closes exactly at the strike price. Here, both options would expire worthless and you would keep the full premium. The maximum losses are potentially unlimited because the stock price could theoretically rise indefinitely. To find the break-even points on your short straddle, simply take the strike price of the options. Then add the total premium per contract received for the first break-even point, and subtract the total premium per contract received from the strike price to find the second break-even point. So in the example we used, the options have a 100 strike. Let's say the trade earns us a premium of $10 per contract. To find the break-even, we'd add $10 to the $100 strike price and get a break-even point of $110. For the second, we'd subtract $10 from the strike price and get a break-even point of $90. So $110 and $90 become the break-even points. As long as the price of XYZ stock stays between these 2 points, you'll earn a profit on the short straddle. Depending on the option, you could have a number of expiration dates and strike prices to choose from. This, incidentally, is one of the strengths of options. Options provide us with choices, and investors can analyze a variety of criteria to determine which of these best fit our needs for a given portfolio. Investors must also understand that time is a double-edged sword, especially for the buyer. Options contracts decrease in value at an accelerating rate as they get closer to their expiration date. So to summarize, this trade generates a large amount of premium for the options seller, but it does come with risks. A short straddle is an unprotected trade, sometimes referred to as a naked trade. Naked options can be risky as they expose the trader to potentially unlimited losses if the stock makes a big move. However, if the trader is right and the stock trades sideways, large gains are also possible. So now that you have a better idea of how to set up the short straddle, let's take a look at my trading platform and set up a real-life trade using Boeing. We are first typing in BA, which is the ticker symbol for the stock. And just for some background here, Boeing has bounced off, like I said earlier, made lows, and is heading towards resistance in the 145 to 150 area. And it's had a very impressive rally from the 120 price level to around 140. And many traders think that the stock is due for a consolidation after these big gains. So a potential trade here, we could look in the July 15th expiration, which is right here. We're going to want to make sure we have the right spread type selected in this box here. So we'll make sure that is a straddle. And we're going to be looking to sell the 140 strike price call and put. So we'll click that here. And we're looking to short this trade, so we want to make sure instead of buy, sell is selected. Now this trade is pretty much ready to go. So to recap, we are looking to sell one July 15th expiring call with a 140 strike and sell one July 15th expiring put with also a 140 strike price. Boeing stock has bounced from the May lows and is heading towards resistance in the 145 to 150 range. The rally from 120 to 140 was impressive, but perhaps now the stock is due to consolidate those gains for a few weeks. Assuming a trader believes that Boeing stock will trade sideways over the next few weeks, they could look to sell a July 15 140 put and a July 15 140 call. Remember, both the expiration and strike prices are the same for a short straddle. Selling those two options would generate a total of $1,645 in premium. That is the maximum possible gain on the trade if the stock closes right at 140 on the day of expiration. To work out the break-even price of the trade, just like we talked about before, you'll want to take the strike price of 140 and then add and subtract the total premium received of $16.45 per contract, which gives us break-even points of 123.55 and 156.45. So below and above those areas, the trade would start to suffer losses. Short straddles are very risky in advanced option trades. Again, I can't stress this enough. The losses are potentially unlimited with them, so if you feel uncertain about anything we just talked about, it's best to practice in a virtual trading account before risking any real capital. Only try the trade with real money if you have a good handle on the risks of the strategy. Always remember that options are complex and investors can lose 100% or more of their initial investment. Be sure to check out investors.com/options for more option trading tips, and we'll see you next week.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.